Welcome to the deep dive. Today, we are cracking open one of the most critical roles in real estate, but one that's often kind of invisible, the escrow agent. Yeah, for most people buying or selling, this person is, well, the difference between a safe deal and potential chaos. Our mission to make sense of this vital safeguard, because they're the big exception in the whole process. Think about it. Your agent, your lender, the inspector, they all work for someone. But the escrow agent, strictly neutral. Their whole job is making sure no money, no deeds change hands until every single legal and financial promise is met by everyone involved.
It's fascinating, actually. The role has deep roots. The word escrow itself comes from Old French.
Oh, really?
Yeah, escrow. It just meant a scrap of paper, like a scroll.
A scroll.
Basically, yeah. The contract held by a third party.
Yep.
And only when the terms on that scroll were met could things move forward. That old idea still holds. The modern contract. That's the scroll dictating everything.
Okay, let's unpack this neutrality right away, because that's the core of their value, right? So they're a neutral third party holding assets, the money, the deed, maybe even keys, temporarily, until the contract says go. But how is that neutrality actually, enforced?
Through something called fiduciary duty. It's a powerful legal standard.
Fiduciary duty. Okay.
The escrow agent has this duty to both the buyer and the seller at the same time. And it's not just good advice, it's a legal requirement. They have to act in the best financial interests of both sides, even if those interests seem to clash sometimes.
Oh, okay.
And this duty, it's backed up by how they get paid.
How so?
Escrow agents don't get a commission based on the sale price, not like a real estate agent. They usually get a salary from their employer, often the title company, or maybe an independent escrow firm.
Salary, not commission. Got it.
Exactly. So they have zero financial stake in just pushing the deal through quickly. No bonus for closing. This means they aren't tempted to favor one side or, cut corners. Security and following the contract, that's their focus.
That makes sense. Salary versus commission is a huge difference. But let me push on that a bit. If they work for a title company, and the title company does make money from selling title insurance and closing the deal, isn't there still potential pressure? Could the agent feel, pushed to maybe overlook a small issue to help the company close faster?
That's a really sharp question. It gets right to a potential conflict, doesn't it? The main safeguard here is the legal liability. The agent themselves and the company they work for carry significant risk. If they knowingly, or even negligently, let a closing happen when there's a known problem like a title defect or an unmet condition,
Right.
they're wide open to lawsuits, serious ones. Loss of license, big financial penalties. So essentially, the risk of getting sued badly outweighs any small benefit of rushing a closing by a day or two. Professionalism, sticking to the rules, that's their real insurance.
Okay, that liability makes sense as a check. Let's switch gears slightly. Let's talk about the main thing they protect. The earnest money deposit. This is that first chunk of money the buyer puts down right after the agreement's signed. Usually, 1% to maybe 5% of the price?
Exactly. It's the buyer basically saying, hey, I'm serious. I'm putting skin in the game.
So it shows good faith.
Precisely. And managing that money, that's where the agent's strict adherence to the contract really becomes clear. They handle the disbursement, or importantly, the return of those funds, based purely on what the contract says about contingencies.
Contingencies, right. The what-ifs.
Exactly. A buyer usually gets their earnest money back if, say, three big things happen. One, the home inspection finds major expensive problems the seller won't fix.
Okay, that's common.
Two, the buyer just can't get the mortgage financing they specified in the contract by the deadline.
Also happens.
Or three, maybe the buyer had a contingency that they needed to sell their own house first, and, well, they couldn't do it in time. In those cases, the escrow agent just looks at the contract, sees the condition wasn't met, and returns the money to the buyer. Simple as that.
Oh.
It's supposed to be simple.
Let's paint a picture here, because this highlights why you, the listener, really want that escrow agent. Imagine you give, say, $15,000 earnest money directly to the seller. You put it right in their bank account.
Risky. Very risky.
Right. Then the deal falls apart. Maybe the appraisal comes in $20,000 low, which triggers your financing contingency. It's a valid reason to walk away. But the seller, they might just say, nope, you broke the contract somehow. I'm keeping the $15,000. Now you have to sue them to try and get your own money back. It's a mess.
A costly, stressful mess.
Contrast that. Same $15,000, but it's sitting with the neutral escrow agent. The appraisal comes in low. The agent sees the report, sees the condition, and the contract isn't met.
And they are contractually bound to return the money to the buyer. No argument needed, no lawsuit, just executing the contract terms.
It's clean.
And it protects the seller, too, let's be clear.
How so?
If the buyer walks away for a reason not covered by a contingency, maybe they just get cold feet or, they get a sudden job offer across the country.
Something not allowed in the contract.
Exactly. Then the escrow agent will distribute that earnest money to the seller. It serves as compensation, sometimes called liquidated damages, for the seller because the buyer broke the agreement without a valid reason. So the agent prevents improper holding of funds, but also makes sure the party who was wronged gets compensated according to the contract.
Okay, so they're much more than just a money holder. They wear a lot of hats, it sounds like. What other big jobs do they have leading up to the closing day?
Oh, absolutely. Title work is a huge one. The agent often kicks off the title search.
Right, digging into the property's history.
Deep dive, yeah. Into public records, looking for any existing liens like unpaid property taxes, old mortgages, mechanics liens.
Stuff that clouds the title.
Precisely. If they find, say, that the county put a lien on the house because property taxes haven't been paid for 3 years, well, that has to be paid off before the sale can close legally.
And the agent manages that.
They coordinate it. They ensure the seller arranges to pay that debt, usually out of the sale proceeds at closing. The agent's job is to make sure the buyer receives a clean title. That's non-negotiable. If a lien pops up, the agent holds the line. They won't let the closing proceed until it's resolved. And often, they're also involved in issuing title insurance.
Ah, the insurance policy.
Right. It protects the new owner and the lender if some hidden title defect or an old missed lien suddenly appears after the closing, maybe years down the line.
That sounds like a ton of critical responsibility. Now, I know this varies by state, right? Like in California, it's specific escrow companies, but maybe in New York, it's different.
That's a great point. And yes, there are regional differences. It's a historical split, really. You generally have escrow states, mostly in the West, like California, Arizona, Washington, where specialized licensed escrow or title companies handle this whole process.
Okay.
Then you have attorney states, more common in the Northeast, and parts of the South, think New York, Massachusetts, the Carolinas.
Attorney state, so lawyers handle it.
Exactly. In those states, historical legal tradition view the transfer of real estate title as fundamentally a legal practice. So, attorneys manage the closing, they oversee the title work, and they handle the escrow function as part of that legal service.
Interesting. Why the split?
It really just comes down to how legal practices and regulations evolve differently over centuries in different parts of the country. In the West, it became more of a specialized regulated business function, separate from requiring a law degree. But here's the key takeaway for the listener. Whether it's a licensed escrow agent in California or an attorney in New York handling the funds, that core fiduciary duty we talked about,
To both buyer and seller.
it's identical. The responsibility to be neutral and follow the contract remains the same, regardless of the professional title.
Fascinating distinction. Okay, let's walk through the timeline now. Put it in order for someone going through, say, a typical 45-day closing. When does the escrow agent pop up?
Right at the beginning. The moment that purchase agreement is signed by buyer and seller, boom. The process usually moves to opening the account.
Step one.
The agent gets a copy of the contract, and the buyer makes that initial earnest money deposit. This first phase is really just setting up the neutral ground, confirming good faith.
Okay, account open. Then we hit the contingency period, inspection, financing, appraisal.
Right.
Lots of hurdles.
Correct. And the agent is basically monitoring the calendar for those contingency deadlines agreed upon in the contract. Take the appraisal. The lender orders it to make sure the house is worth the price being paid.
Yeah.
If it comes in low, that's a potential crisis.
Right. Let's say list price is $500K, appraisal is only $480K. What happens then?
The agent waits for instructions based on the contract. The parties might renegotiate the price down to $480K, or the buyer might decide to bring an extra $20,000 to closing to make up the difference. Or, if they can't agree, and the contract allows it based on the appraisal contingency, they might mutually agree to cancel the whole deal. If that happens, the agent follows the contract, returns the earnest money, and closes the escrow account right there. Deal over.
Assuming it appraises okay, loan gets approved, inspections are fine, we're heading towards the finish line. The closing meeting itself, what's the agent doing then?
They're busy. Just before closing day, the buyer usually does their final walkthrough.
Making sure the house is as expected.
Exactly. Did the sellers move out? Did they leave the appliances they promised? Is the place reasonably clean? Basic stuff. At the same time, the escrow agent is finalizing and sending out the closing disclosure, or CD.
Ah, the big document with all the numbers.
That's the one.
Yeah.
Legally, the buyer must receive this at least 3 business days before the scheduled closing. It details every single final cost, the loan amount, down payment, all the closing costs, how much is going into the new escrow account for taxes and insurance, everything.
3 days to review. Okay. And then the closing itself, everyone signs. What happens immediately after the last signature?
That's when the agent orchestrates the final disbursement. It's complex.
The money movement.
All of it. First, they verify all the funds are in place, the buyer's final payment, the lender's loan funds. Then it's like a financial traffic controller.
Yeah.
Wire funds to pay off the seller's existing mortgage. Send the net proceeds to the seller. Pay property taxes due, any utility adjustments. Pay the title company fees, the real estate agent commissions, the homeowner's insurance premium, maybe HOA dues.
Wow, okay. Directing traffic is a good analogy.
It really is. They ensure everyone who is owed money out of the transaction gets paid correctly according to the settlement statement.
And the paperwork side, after the money moves.
Crucial final step. Once all funds are dispersed, the agent takes the new deed and the deed of trust, or mortgage document, and gets them officially recorded.
Recorded where?
Usually at the local government office, could be the county recorder, county clerk, register of deeds. Varies by location. Filing that deed of trust is absolutely vital. That's the public record confirming the buyer's promise to repay the loan, and the lender's security interests their claim on the property until the loan is fully paid off.
If the agent messes that up.
Big problems. The lender's security isn't perfected legally. That's why this final recording step is handled with such care.
Makes sense. Okay, let's pivot to personal finance. People often hear about escrow being part of their monthly mortgage payment. PITI, principal, interest, taxes, insurance. Is that escrow account mandatory for everyone?
Good question. No, not for everyone, but it is mandatory for a lot of homeowners. Generally, if your down payment is less than 20% of the home's purchase price, your lender will almost certainly require you to have an escrow account.
Why the 20% mark?
It's about risk for the lender. If you put less than 20% down, you have less equity, less skin in the game. The lender sees that as higher risk. If you were to stop paying your property taxes or your homeowner's insurance, that puts their collateral, the house, at risk. Liens could be placed, or the house could be uninsured if it burns down.
So they take control.
They mitigate their risk by collecting 1/112th of your estimated annual tax and insurance costs each month with your mortgage payment. They hold it in the escrow account and pay those bills for you when they come due.
Okay. And what about government-backed loans? FHA, USDA?
Yes, those typically mandate an escrow account regardless of the down payment size. It's just part of the program rules.
No VA loans, too.
VA loans are a bit different. The VA itself doesn't always require it, but the individual lender providing the VA loan often does. So it depends on the lender's policy for VA.
But if you do have a conventional loan and you put down 20% or more, you might get a choice.
Correct. In that scenario, you often have the option to opt out of having an escrow account managed by your lender. You can choose to handle the tax and insurance payments yourself.
That sounds tempting. Lower monthly payment, maybe, more control. What are the real pros and cons of opting out?
The pros are pretty straightforward. You manage your own money. You could potentially earn a tiny bit of interest on the funds you're setting aside for taxes and insurance before the bills are due. And yes, the monthly payment to the lender itself will appear lower because it doesn't include the T&I portion.
Okay. Sounds good so far. What are the cons?
The cons can be significant, and this is where people sometimes get into trouble. First, the lender sees you opting out as slightly higher risk for them.
Even with 20% down.
Even then. So they might compensate by charging you a slightly higher interest rate on the loan itself, maybe 1/8 or 1/4% higher.
Wait, so opting out could actually mean a higher overall monthly cost when you factor in the increased interest.
It absolutely can. You have to run the numbers carefully. The slightly lower payment from dropping escrow might be completely offset or even exceeded by the higher interest payment over the life of the loan.
That's a huge potential catch. What else?
The other big one is simply the discipline required. Property tax bills and homeowners insurance premiums are usually large lump sum payments due once or twice a year.
Yeah, they can be thousands of dollars.
Exactly. If you haven't been diligently saving that money yourself every month, essentially creating your own personal escrow account, you could find yourself suddenly facing a huge bill you can't pay.
And if you miss those payments...
Bad news. The county can put a tax lien on your home. The insurance company can cancel your coverage. Both of those things put the lender's investment at serious risk, so they will step in, often force placing expensive insurance or paying the taxes and then billing you, potentially starting foreclosure if you can't catch up.
Ouch. Okay. So the lender's escrow account, while maybe a bit annoying, provides a lot of security.
It does. It ensures those critical large bills get paid on time, every time, protecting both you and the lender.
All right, one last point of clarification. We talked about the escrow agent holding assets until conditions are met. That sounds a little bit like a trustee, someone who manages a trust fund. How are they different?
That's a really insightful comparison. The core difference lies in who the fiduciary duty is owed to. An escrow agent, as we've said, is tied to a specific transaction, usually the sale of real estate. Their fiduciary duty is unique because it's owed equally to both parties in that transaction, the buyer and the seller. They ensure fairness for both sides according to the contract.
Okay, duty to both sides in one deal.
A trustee, on the other hand, oversees the trust. This is usually a longer-term arrangement, like managing assets left for a child until they reach adulthood, or for a charity. The trustee's fiduciary duty is owed only to the beneficiaries named in that trust. Document the child, the charity, whoever. They don't owe that same duty back to the person who created the trust, the grantor or settler.
Ah, so it's about the scope and direction of the duty. Escrow is dual direction for one event, trustee is one direction to beneficiary over time.
Exactly. It's not so much what they hold, but who they are legally obligated to serve and protect in the process.
That clears it up perfectly. So the escrow agent, really, is your impartial insurance policy during a complex transaction. They're the objective party making sure that huge transfer of money and property happens exactly as agreed, securely, provides crucial certainty.
Absolutely. It provides peace of mind in what's often the biggest financial transaction of someone's life. And maybe a final thought to leave you with, building on that complexity. We talked about deals falling through because of buyer issues, like financing. But flip it around, consider this. The title search reveals a major, unexpected lien on the property, maybe an old, unpaid contractor lien for $30,000 that the seller is contractually obligated to clear before closing. But the seller just refuses. They won't pay it off.
Ooh, sticky.
Very. Now, imagine everything else is ready. The buyer has the loan, all the paperwork is signed, the closing disclosure is done. But that one massive condition delivering clean title hasn't been met by the seller. What's the escrow agent's duty then regarding the timing of releasing funds? Even if everyone else is screaming to close.
They can't release anything, can they?
They absolutely cannot, because the seller failed their contractual obligation. The agent's only loyalty, their only master, is the contract itself. So the closing stock's dead. No money moves until that title is cleared, or the deal collapses according to the contract terms. It just highlights again how central and how rigidly bound by the agreement that neutral role truly is. Something to chew on next time you're facing that mountain of closing docs.